Good morning, everyone. This is Patrick from Hedge Plus coming to you after the USDA report that we had on Friday this week. It was somewhat bullish for corn. That's good news, right? We lowered ending stocks to just under 1.8 billion. That's great news. Okay. However, we are facing what I believe is a new seasonal trend that will be in place for years to come. And that is putting in lows between the middle and the end of August. And that is huge risk. So let's talk about that risk and why we moved down to lower prices at the end of August. Bottom line is we now have a very large crop coming to market, being harvested right now and challenging our exports for the rest of the summer. And that's the Brazilian Safina crop. It is about as large as last year and will lead to significant export competition with the rest of the world with our corn. If we are not low enough, we will lose exports to the Safina crop. So lower prices have to happen to compete with the Safina crop. At the same time, this year, we have 680 million more bushels of corn of old crop to move between now and plant and you guys harvesting than what we did last year. If you look at this year's supply and demand report, what we're expecting versus last year, we're looking at about 680 million more bushels this year in ending stocks compared to last year, 24, 25, 25, 26. That is a lot, okay? That's a lot of bushels. And having 2 billion bushels of the 25 crop to move out of the bins before the new crop can get in will pressure prices. Why? End users know that 2 billion bushels will come out between now and mid-September. They also know that we have a lot of corn forward priced of the new crop. We hit $5 this year. Our average cash price is $4.93 December futures on half the crop. That's half of the 2026 production already forward priced. With good forward pricing for this year, 2 billion bushels of old crop that we have to move, and a very strong competition from the Safina crop. The last 2 years, we went down to contract lows for December futures in the middle and at the end of August. I expect the same thing to happen this year. So your risk right now isn't long term, it's short term. It's over the next month and a half. I am maintaining a strong hedge position going into the 1st of September. We'll look for buybacks after that. But the bottom line is you have a ton of risk if this goes down. What happens if I'm wrong and we don't go down to, say, 410 December futures, and instead we stay flat around 450, 460, or even rally a little bit? Well, my expectations change dramatically then, because I think we go up to at least 520, and I sell my crop for over $5 a bushel on front month futures. So what's your risk if we stay here or go higher? Minimal, right? I don't think we're going to stay here and go higher over the next month and a half and not have some kind of issue with a crop or really, really good demand that's going to drive fundamentals and lower ending stock. If that's the case, we're going to have a rally and it's going to be significant and you guys are going to get great prices. If we don't, and we have a normal seasonal trend lower, 410 is a lot harder to push prices up above $5 than 450 or 470, okay? We need to have you guys hedged right now to protect the downside. It's a smart thing to do, not because I can predict the market, but because that's where your risk is right now. Have a great week. I'll be calling my clients to make sure that we're covered to the downside. And I hope I'm wrong and that we rally to $5 right now. That'd be great. Have a great week. Talk to you soon.